But my time on Wall Street kind of gave me a real purview of what happens inside from funds, as well as what happens, as far as the client experience at institutional level. And I found insurance to be the most flexible product I've ever seen.
Yeah,
Kind of fell in love with it.
Yeah, and no one knows about it, and it's still they still fight it today.
My money.
I get money from you.
Money in the bank.
Young money.
It's a rich man's world.
I grew up here in Chicago. Went to public school here in Chicago and had the great fortune when I got to college to meet a man named Dr. Clinton Bristow. And if you look up Dr. Clinton Bristow, he was the dean of the College of Business of Chicago State University, where I went to undergrad. But he went on to be the president of Alcorn State University. And he mentored me for a lot of years while in undergrad. And then after I graduated, he introduced me to a financier here in Chicago, who is now a billionaire. He wasn't at the time. And so I worked with him for about 13 or 14 years. I learned a lot of finance from him. It's kind of how he did things as far as investing in markets. But also, I started the board of trade when I was 19 years old as a runner.
How did you do that? Would you just you're just a hustling kid, or?
I watched Wall Street.
Trading places or something?
It was actually Wall Street and Gordon Gekko, but it wasn't Gordon Gekko that motivated me. It was actually Bud Fox. I was in college when I saw the movie, and I thought I had more drive than Bud Fox. And if I could, apply myself and not break the rules, then I could, be successful, as successful as Gordon Gekko. That was my mind. And so I decided literally, I went to the board of trade. I went so I could get started because I thought I could be more successful than Bud Fox. And I got a job as a runner in the grains pit. From there, I was a prospect clerk at a brokerage firm. And then I finally, because a guy there told me, in fact, that I should go to college. He said, because I wouldn't necessarily get an opportunity to be a broker at the firm I was working. And the way he told me was, he took me to the side, he said, look out there. He said, how many black brokers do you see? And I said, one. He said, how many black prospect clerks do you see? I said, the room's full of them. He said, if this firm were promoting prospect clerks to brokers, wouldn't there be more black brokers? I said, yeah. He said, you're working your butt off and they're never gonna give you a chance. He went on to say to me that the only reason he was telling me was because he had taken a job as a CFO for Mrs. Fields Cookies.
Mrs. Fields Cookies, really?
Yeah, so he was leaving, but he wanted to take time to talk to me. He's a white guy, because he saw me working so hard and thought I would never get an opportunity. So I quit, went back to college, came back, got a job as a clerk at a brokerage firm, and where I learned how to, I got qualified as initially as a stockbroker, as so I got a Series 6, 7, 63, 65, and 24, kind of my 20s. And then I worked on a bond desk and equity desk. I then went to work for a hedge fund, first as a clerk, and then I was promoted to an arbitrageur. And then from there, I became a proprietary trader at the board of trade. And then from there, I started giving advice. So I worked in bonds, equities, trading, hedge funds, and now I give advice. And then I also started selling insurance part-time when I was in college. So I always had an interest in the business, and so I think I was built for it. And so that's how I wound up in the space. But my time on Wall Street kind of gave me a real purview of what happens inside from funds, as well as what happens, as far as the client experience at institutional level. And I found insurance to be the most flexible product I've ever seen.
Yeah,
Kind of fell in love with it.
Yeah, and no one knows about it, and it's still they still fight it today. It's just now. Though also too, you're involved in not just about money, but you're also involved like with nonprofits. You mentioned a little about the thing. Yeah, so you're very involved.
So we do a lot of work in the community. I mean, I feel obligated. There are very few people with my background and experience who look like me. So we do some work with the DuSable Museum here in Chicago, where we've been teaching a class which we call How to Rob a Bank, a Wealth Acceleration Strategy. We have a disclaimer saying we don't actually teach you to rob a bank, but we do show people, as you and I've talked about a number of times, how to leverage the curve in their favor. And what I mean by it is the compound interest curve, right? And so few people understand it. And if what was his name? He said, those who understand compound interest earn it, and those who don't pay it. That was Albert Einstein.
Yeah, I think Einstein said that, didn't he? I think
yeah. And so what I realized is the vast majority of the public does not understand how compound interest works. And they wind up paying it on their credit cards and on their long-term debt. They actually get what I call to the right side of the curve, right? So you got a left and right side. Left is kind of the build up. And we get that right side of the curve. Once you kind of cross over, the compounding becomes significant. You know this, but a lot of times people don't. In fact, I think you make something like 80% of the growth in 1/3 of the time once you get over to the other side. But I think life interrupts that left side, right, as you're trying to build up. And one of the things that you and I talk about a lot is having an endowment or a life insurance policy structured in the same way that institutions use them. You got to position yourself to get to the right side of the curve on your savings.
Now, in these precarious times, Gary, that means 43 million people. I think you and I were talking yesterday that like 43 million people out of work, but the market keeps going up. You know, it's all, there's no connection whatsoever to the real economy and the stock market, out there. There really isn't. And so the market keeps going up because money is forced into what they call it disintermediation. Money is forced into a risky position in search of yield.
What you're describing, though, this market's disconnection to the public, really goes back to the 1970s, the early 80s, when households used to own most 80+% of the markets. In other words, people at home were owning the markets. You had a changeover kind of late 80s where it became more agency owned. And today, which means it's owned through institutions. So now most of the markets you see that's taking place, or the investments and the investors in the market, mostly now consist of institutions holding money on behalf of households. So your 401k plans, your IRAs, your institutional assets now. So those transactions now, where it used to be owned by households, now owned by institutions, kind of change the dynamic as well as the connectivity to the general public. Now, what we know, 43 million people unemployed is only half the story. Well, most of the story, but you also have, what we call independent contractors, who are also, you got another 7 million people, 6 million people there, who are also unemployed. And so so when you look at earnings, how a company's going to maintain their earnings when no one is working or spending money, most of this is being kind of a bubble, I call it, and that's my perspective of it, because it's being supported by things like unemployment, income, it's being employed, all these other all these other resources being paid out by the federal government, the stimulus package. But the reality is people aren't at work, and unemployment only goes so long, so it's not sustainable over the long term. And it also speaks to how we're going to recoup the $2 trillion we spent, which means taxes are likely to go up on the working class going forward. So this disconnect in the markets look fairly normal because people still have income, and you have institutions who are still investing. But on the ground level, right, what's happening on the ground is that people don't have sustainable incomes right now. They're not even paying rent, a lot of them in their apartments at this point in time, because you have these moratoriums on foreclosures as well as evictions, so they're paying their mortgages. That won't stay. So what happens when life goes back to normal from an economic standpoint? That means that people are going to have to use their current income or lack thereof or savings to deplete just for their survival until that runs out. The way I describe it is this way. You've probably flown into O'Hare Airport. It's Chicago, so O'Hare.
Been there, you can see all the planes flying all around, yeah.
Absolutely. And there are times in which when, one of my clients is actually a big deal there at O'Hare, and sometimes they have to, because the runways may not be clear for snow, they've got what they call rack 'em and stack 'em, right? You got to get in the plane before when you're waiting to land, trying to find a runway. Well, if you think of the economy this way, right, or business companies this way, some of them have sufficient fuel to remain in the air for a significant period of time.
Yeah.
But a lot of them, right, got to start landing. So in the same way, if they start running out of fuel, they're going to start crashing to the ground. The same is true when it comes to savings, right? Right. So you're kind of hovering at the moment, burning through your cash flow or the stimulus package. But there does come a point in time where you either got to land, get a job, additional income, or you're going to crash.
Crash.
So I think our economy kind of looks like that. The companies that are surviving are those that had deep capital reserves, as well as now stimulus money from the government. In the same way, families that survive are those who had savings in place and are getting stimulus from the federal government until that runs out. And if there's the benefit, of course, of being professionals who can work from home like you.
Yeah. Well, I'm actually in my office, but but you're working at home, but
or like me. And so if you have that opportunity, then you can continue arguably making a living. But how long does this last in this environment? The point I would try to push over to families is, if you look at your own financial situation, honestly, and you say, okay, we've got this coming in, we've got this much saved. And then ask yourself what happens if you don't return to work. Or if there's they say that a third of the people won't return, but it could be as much as half. You've got a real calamity coming when you think about commercial real estate as a whole. How's that going to be absorbed when companies are now figuring out how to get people productive at home and to manage them? You don't necessarily have a reason to continue paying for office space. Small office space like yours is also going to be put at risk, because the reality is, you're not necessarily seeing people anymore in your office. So I meet with most of my clients online at this point. And so I'm contemplating and questioning now, do I continue to maintain an office, or do I just continue to work as I'm meeting with you now? Because the expectations have changed as a result of COVID. I used to have to fly around to see my clients in San Francisco, Los Angeles.
Yeah. So you fly around. I remember last time I saw you in Florida. You're here or there.
I got to get around. But now, people are satisfied with a Zoom call. And you can share documents and have a whole conversation. So why continue to spend $25,000, $30,000 a year on an office when you can literally just set up in a room with your computer? Someday in Chicago.
But I want to circle back to the one problem, which you really hit it, and I didn't even talk about it when I was preparing for this, is the agency problem, which is, to me, it's so enormous, and it's like, and the funny thing is, anyone who goes into Yahoo Finance within 5 minutes could figure out what I'm talking about. But so what you had, years ago, or even 20, 30 years ago, they had a lot of brokerage firms raising money in capital markets, and a lot of individual players in the market. They're all gone now. It's all charged by the giants, the BlackRocks, the Fidelities, the Vanguards, the State Streets, the Invescos, what have you. And there's really no stewardship. Is there? I mean, Gary,
well, from an individual household standpoint, right? We talk about, I always call this alignment, right? And when I think in terms of alignment between a person and an advisor, the first question you got to ask is, how are you aligned with your advisor? They work for you or they work for the institution? Right? And one of the questions I always ask people is, has your advisor ever told you to sell? Ever? And so for me, if I'm getting objective advice, sometimes, depending on the circumstance, the right answer may be to sell. Right? But that doesn't come up. That doesn't ever come up. No one ever says sell. Even the smartest investors, some of the smartest people that I respect, will talk about, long-term and never get time to sell, always hold, right? But they don't account for life. And everybody thinks that the way to get rich is to be invested in the markets. And I'm not saying that there's not value there, but it's no one thing. We talk about the creation of wealth. You want to take advantage of everything available to you. I do believe investing in markets. Absolutely.
Yeah, I do too.
But I think you have to have a certain amount set aside that you're prepared to go through the highs and lows. And I think the older you get, the less that should be. You know what I mean? The older you get, it makes it how rich you are. The assets, the dollar amount doesn't matter, but as a percentage of assets, I always tell people to think in terms of the red, green, and yellow money, right? Red money's got to be there. It's like blood in your heart. Without it, you're dead. So things like retirement or paying for the kids' college education, or whatever you may have that you must have at the time, and there's no opportunity to kind of put it back in place. If you don't build over time, it's not there. That's red money. Yellow money being in case of emergency. And because of the way you and I tend to structure things, they kind of do both at the same time. Yeah. That's in case something happens where you need cash now, right? I had my water heater in my house went out, and they wanted like $2,500 to $3,000 to the whole thing, right? And it's got to be done now because we got cold water, right?
Yeah.
So, you know, and so that's not so much a big deal for you, you know, my modest income.
No, I just want to be like Gary when I grow up.
I just think I'm suggesting I would need more, and I need it right away. And so you have to have something set aside for those things. And finally, green money, which I categorize as money you can set on fire. In other words, your real life won't be disrupted. You know, the things that matter most to you, your comfort won't be disrupted if this money goes away. And the way that came about for me was I dealt with a doctor in California, young doctor, I mean, under 40 years old. He was making a fortune. He was what we call stratification economics. He had the benefit of his parents. We had put some things in place for him. So everything he needed, his red and yellow money, was taken care of. And his salary as a doctor was all green money. And he basically told me, he said, I want to swing for the fences. I don't care. You can tell me to invest in an oil field in South Africa, and I'll do it. And the problem I had was it went against my own conservative nature. And this is some years ago. I couldn't help him because I thought he was assuming too much risk.
Yeah.
And the reality is, I should have recognized it as his green money.
He counted on America to be passive. He counted wrong.